Money Sense, bringing an informed financial perspective to the Cayman community.
Good morning and welcome to Money Sense. I'm your host, Neville Hicks, alongside my co-host, Christoph Barnett.
Good morning, Neville.
Good morning. Joining us in studio, we have Emil Kalinowski, CFA. Welcome.
Gentlemen, it's a pleasure. Thank you very much for inviting me. I look forward to talking about precious metals with you.
Yeah, so Emil is a precious metals analyst located here in the Cayman Islands with a large global company. So we're absolutely thrilled to have you on the show, get some insight into what precious metals are, and from some investment ideas and certainly some things for our audience to think of when it comes to precious metals. So when I hear the term precious metals, what does that actually mean, Emil?
Gold comes to mind immediately, and then not too far behind is silver, but there are actually more precious metals than that. Most famously are the platinum metal group, palladium, platinum, rhodium, but those are much rarer, and you can use them in jewelry and in auto catalysts, but they're not seen as precious metals in the same light as gold and silver are. So when people bring up precious metals, gold and silver.
So rare, but not too rare.
Exactly. And that's what led to gold and silver becoming monetary assets throughout history. If you look at the periodic table of elements, and you're looking for something that's durable, divisible, you'll narrow it down. You can't use the gases, obviously, and then copper, lead, zinc, they'll erode, eventually corrode, oxidize. But so eventually you narrow it down to the precious metal groups, and then you get to that point that you just mentioned. It can't be too rare, like platinum and palladium. And gold, that's how gold and silver naturally emerged over millennia across cultures as a form of money.
Mm-hmm. And gold itself, I think we can all kind of relate to gold, but you mentioned a good point about talking about a store of value. Is that, how has that derived over these centuries, and why has that come to be? I mean, gold itself, sure, you can wear it. It looks nice. It doesn't oxidize, as you mentioned. But why are people comfortable with gold?
It just naturally emerged. If you look throughout history, you'll see that the ancient Egyptians, the Sumerians, the Han culture in China, Inca, Aztecs, modern times in New York, Tokyo, Hong Kong, Paris, just through time, it naturally emerged as something that's durable, divisible, not too rare, and it's a store of value in times when perhaps things are difficult. You don't know where to put your money in. This is a small, high-dense value item, and that's how, over time, nations, countries have relied on it, and people, as a currency and a store of value.
So if we think about, let's say, in the current modern sense, we have paper money, right? So if we think, let's store a lot of, if we're a bank and we want to store a lot of paper money in a vault, well, will that paper money last? Well, we all know what happens to paper over time, and whether it's rot or a hurricane comes through and it gets flooded, or rats start chewing away at it. But gold will still be there unless you lose it or it gets taken from you. It'll be there itself, the material itself, and so that's the natural emergence you're talking about. But where do we actually get gold? Like, we've all seen the panning of the gold on the river. Mm-hmm. Is that where it comes from? Just the old prospector?
That is exactly correct. Modernized using amazing tools and trucks the size of buildings. So that's exactly correct. Just at a futuristic advanced level. You can find gold predominantly in Australia, China, Canada, the United States, South Africa. So that traditionally those have been the biggest producers. But you can find it most anywhere. You really can. It just depends on the geologic formation. So, for example, in South America, there's a lot of copper and gold naturally associated with copper. So even though we look to South America as a copper belt, there's more than enough gold there associated with that copper.
And silver, is it similar? Mines all over the world?
Exactly. Silver, similar mines all around the world, different kind of mines. So lead, zinc mines, for example, you can find a lot of silver there. Gold mines, you'll find silver there. While in copper, you wouldn't find as much silver.
And on silver, we obviously use silver jewelry or have silver jewelry, but silver is slightly different from gold in a sense of it actually has a industrial use.
That's right. It's 50% roughly of demand each year goes towards industrial production in things such as solar panels, electronics, various other industrial uses. And then the remainder you can split through decorative uses such as jewelry and silverware. Silverware used to be a big thing. Unfortunately, that has left us. Remember in the 1800s in your books, in your Charles Dickens books, everyone's got silverware that was being stolen, right? That was a form of value, but unfortunately silverware not as popular anymore. But decorative uses for silver, industrial uses, monetary, but that's the key difference between gold and silver, is there's this very large component that is industrial in nature, about 50%, whereas gold, it's about 10% is used for industrial uses. And it's primarily jewelry, which is about 50%, and then the remainder is used by central banks and by local investors, small investors, for wealth preservation.
But we'll get into the wealth preservation, the returns, whether it's a good investment or not. But are we, just to wrap up on the mining, are we producing more gold and silver in a historical context, or is it about the same?
We are producing as much as ever, and that was driven primarily off of the great bull run in prices since 2000. So as prices rose, it was more economical to mine the areas that had previously been not economical. And so miners went to business, produced a lot more gold and silver. Prices turned around 2011, and the financial markets have not been supplying the capital to the miners to go do further exploration, expansions. And so we have reached an inflection point, and the forecasts are that going forward we'll be producing less gold and silver year over year. It won't be dramatic. It'll be just about 1% less each year.
Unless the price explodes and then it becomes worthwhile to reopen the mines.
Exactly. It's always a matter of price. And currently, you can expect less mine supply. I would like to add, though, that there's an above-ground stock which comes in scrap. So think of your jewelry, think of your silverware, and if prices rise, you can expect that to come into the market. And about 15 to 20% of annual supply, overall total supply, comes from scrap. And about 85...
So reused gold,
that's
effectively.
That's exactly right. That's how valuable it is.
Right.
No one throws their gold away. No one throws their silver away. Copper, lead, zinc, it gets used up, hopefully gets recycled, but no one's keeping it, right? No one's making sure, I've got to hold on to that copper. Gold and silver, it comes back about 15 to 20% in scrap.
So let's move on to the price. So silver, around, I guess, $19 gold, $1,250, $1,200 or $1,250 per ounce. Now, why that discrepancy? So it's still an ounce of material each, but why is one so much more valuable than the other?
Just more supply. There's more silver. It's naturally occurring greater supply of silver. Plus the silver, again, it's used for industrial uses, so more of a day-to-day use. And then the gold is just rarer, more highly prized. There's a sentiment, an aesthetic appeal more towards gold. And it's just, if again, thousands of years, multiple cultures have agreed on this, that they feel gold is valuable. And so just naturally, over time, people, they look back through history and say, yeah, everyone agrees this is valuable. And it's just naturally become that way. So right now the ratio is about 50 to 80, depending on the year, last 40 years or so.
So that's the price of gold to silver. So 50 times the price of silver is gold, or up to 80 times the price of silver.
That's right. That's right. Okay. In previous eras, it was much lower.
80 times as valuable.
That's right. 50 to
Per
80
ounce.
times. Exactly.
Yeah.
Exactly. In previous eras, the ratio was much smaller. 1930s, 1800s, the ratios were in the 15, 20s, that sort of area. So different eras, different requirements, different sentiment, different aesthetic tastes.
Would you spending your time looking at both gold and silver, would you say, I guess from a predictability standpoint, silver is more predictable in a sense of it has an industrial use, where gold is a tool for storing wealth or currency or somewhat of an investment?
A couple of things in there. I would flip that on its head. I would say actually silver is less predictable. It's more volatile. The prices change more because it's got multiple roles. It's got two hats on. It's an industrial metal. So how's the global economy doing? And it's a store of value, and it's an ornamental item. With gold, a little bit of industrial use, but primarily it's used by investors and central banks as a store of wealth, and in the Far East, in India and China, again, store of wealth in the form of jewelry. So it's much more singular purpose, which is wealth preservation and ornament versus both industrial uses with silver. And the market is much bigger. Gold is a very big market. It's one of the biggest markets in the world. When you look at all financial assets, gold will rank in the top 10. Silver, small market. That's why in the early 1980s, a pair of brothers, the Hunt brothers, were actually able to get on the path of trying to corner the silver market, right? Because they could raise enough funds to do it. You can't do that with gold. You would need a tremendous amount of money to try to manipulate the gold price. So gold, much more stable, silver, more volatile.
So we've talked about cultures agreeing on the use of gold as a store of value. But what about as an investment? What have the returns of gold been historically?
That is a great question, and I think that is the key question to understanding gold's role. Again, in real terms, physical gold is what I'm talking about, not ETFs, not mining companies, but physical
actually
gold.
Owning a gold bar, let's say.
Exactly.
Or a gold coin.
Hold on there, gold coin. We're not all that rich.
That is exactly it.
Dream big, right? Couple gold bars.
Is it an investment? And I'm going to say something now that's important. Its role is not to be an investment. Its role is to be a store of value. Capital assets like stocks and bonds are investments. You put in capital and you're taking a risk and you expect a return. That is an investment. Gold and silver are stores of value, time-tested. If you look back, there have been several studies. In the United States, going back to the early 1800s, gold's return has been about 1%. If you go back to the middle of the 13th century, in the United Kingdom, gold and silver's return, again, just under 1%, but, let's say 1%. Internationally, if you take a look at many countries since the 1900s, and you average them all together and you see how gold performed in those local currencies, again, 1.5%. So very little return.
That
Why?
doesn't sound terribly compelling.
No, but as an investment, absolutely. But why are you getting so little return? Because your risk is so low. That's the point. It serves a role of being a robust form of insurance. You would not get paid a tremendous amount of money for something that is near riskless. Of course, we're on Earth, so there's nothing riskless, but it's a peerless store of value, near timeless, near riskless, and therefore your return is about 1% per year. You should not look, in my opinion, you should not look to physical gold, physical silver as a return vehicle, as an investment. You should look to it as a form of insurance. It is a way to minimize your maximum regret, whereas capital assets, stocks and bonds, are vehicles to maximize your return. And you both have a role. Today, in today's environment, you do not hear a lot of enthusiasm and support for that role that I mentioned for gold, the role of minimizing your maximum regret. Everyone's talking about maximizing returns. And that makes complete sense in an era, in one era. But when we transition from one era to another, it's volatile, destabilizing. When we transition from one economic era or one political era, you can have these kind of destabilizing events, and that's when you want robust, resilient assets,
i.e., gold. And when you're talking era, I guess you're saying that could be a significant amount of time.
Absolutely,
right? 100 plus years, or even more.
I would say even less.
Okay,
even less. Our current monetary era started, let's say, most explicitly when we went off the Bretton Woods standard in 1971. But I think we've also been on a Eurodollar standard since the early 1990s. That may be getting in too deep, but the idea is their eras happen much more frequently, let's say 20 to 40 years.
Okay, great. Well, we're going to take a quick break, but please join us back after the break as we continue to talk about gold and precious metals. Good morning and welcome back to Money Sense. I'm your host, Neville Hicks, alongside Christoph Barnett. In studio, we have Emil Kalinowski, CFA, who's a precious metals mining analyst, and he's given us some great insight into what's going on with gold and silver. And I think picking up on our point before the break, Christoph had a couple questions.
Yes. Emil, you were describing gold historically as a store of value and going through the historical long-term returns. Long-term is important because over a long period of time, these things go in cycles. But there's a few points that I want to draw out there, and that is people thinking, oh, well, I'm going to make all of this return from gold. Well, that's not the role, and I totally agree. The role is to preserve wealth, because often it's in a context of, oh, the world's ending, and so we have to have this gold, and the society is going to collapse. Well, the end of the world is historically a bad bet, because first, it's only going to happen once, and two, when it happens, you're there with your gold, and okay, you were right. It's not very consoling.
What do you do with your gold when the world's
to win that bet? But what has happened is it's been the end of the world for some people, some cultures, some societies, some countries, and more important in a relatively modern context, eras, use the word eras, or I'll say financial systems. So when you study history, you realize that the current financial system has not always been as it is now. We're used to, well, if we need going to the UK for vacation, we buy some pounds, or if we're going to Europe, we buy euros. Well, it didn't used to be this way. It used to be fixed exchange rates, and gold was fixed to the dollar, and so on and so on. And before that, central banks would convert dollars and so on. You can get quite deep into this. But the point is that circumstances changed, and depending on what capital assets you held, what bonds, what stocks, sometimes companies can go bankrupt and not pay, or the currencies can go away. But gold has continued to exist. And so when you said, Riskless is, or very low risk. Just want to again point out that it's not in terms of, I can never lose money in gold, but as long as we're here on Earth, the gold will exist, is the point you're making. The countries can go away, the currencies can go away. So that's what I wanted to point out. And then finally, this has some important ramifications for how much gold should I have. Well, if I think, I'm going to get rich on gold, it's going to go up, it's going to double next year, I should put all my money in gold. Well, historically, we've seen that that's not probably going to happen unless you're the world's best market timer. Mm-hmm. That's because there have been short-term periods of great increase, especially in the last 15 to 20 years. But in terms of your percent holding, if you think I'm not going to get my returns from gold, I don't want to put all my money in gold, but I do want to have a store of value for when eras change. So what percent, when I'm thinking of an investment portfolio, what range of percents are talked about when holding gold in the context of an investment portfolio?
What you said at the very beginning was very eloquently stated, and I second that. Regarding the proportion of a portfolio that is devoted to precious metals, gold, I have read a lot on this, and let's start at what is currently held. And it's my understanding that if you look at all the institutional wealth, about 0.3% of it is devoted to gold, roughly. Mm-hmm. Certainly less than 1%. Central banks own more of their wealth in gold. But how much should you personally have? Well, from all the research, from all the experts I've read, it's something between 5 and 25%. So the World Gold Council did a study where they evaluated the risk-adjusted returns of gold in a portfolio. What is the most efficient level? Well, it depends on what your mix of capital assets is. But their eventual number, they settled on between 2 and 10%.
So not 100%, Neville.
No. That's right. That's right.
All those gold bars, right?
You don't want to have too much in any one asset. Right?
No,
you could be wrong in what's happening. You could be wrong. So you want a minimum and you want a maximum. Mm-hmm. And the minimum and the maximum is up to each investor. The ranges that I have heard are between 5 and 25%.
I like the analogy you used earlier when you referred to it as more insurance. Mm-hmm. Yeah. Right? If you think about your home or your insurance on your home, that your home is obviously an asset that you have. And you have insurance on that. Now you don't take out, if your home's worth X, you don't take out an insurance policy that is worth 10X and pay for that. So you almost look at gold in your portfolio in the context of an insurance policy of a change in the financial system or structure.
Mm-hmm. That's exactly right. I love that analogy. And again, it's a great way of identifying what gold's role is. You have a house and you get fire insurance on it. Is that an efficient use of your money? No, definitely not. You should have gotten new wooden floors, because when you resell your house, you will make much more money on your house than you would have on, quote unquote, wasting the money on fire insurance. Mm-hmm. But I think we can all agree, insuring your house for fire insurance, flood insurance, personally having life insurance, these are wise decisions, and you don't make them with the idea, I want to be efficient, I want to maximize my return. These are moves that minimize your maximum regret. And again, that's where gold steps in, silver, they step into.
I'm
help
hoping
balance.
to never collect on my life insurance. How about that?
Your family. And that's also, again...
they're never going to collect either. I'm here for a long time.
But I guess therein lies, if you have a gold investment and gold's $12.50 an ounce, and if gold was to go to $5,000 an ounce, that probably wouldn't be good for the rest of your investable assets.
Excellent point, because you actually don't want insurance to pay out because something bad has happened.
Correct.
Like for the rest of my life, if I never have an insurance policy pay out, that'd be a great life, right? That means I never got in a car accident, the hurricane never caused any damage, I didn't have a premature loss of a loved one, etc., etc. That would be a great thing. And so when I think about gold, I think, well, I hope that we never have this increase to 5,000, 10,000 because something bad has happened. Now, historically, whether you call it bad or good, there have been changes to the system, and there probably will be changes. You mentioned a couple points there, and we could, different people can, I guess,
probably spend another
their own research
10 shows
and
on
the
hashing that
history of
stuff out.
changes in the financial system. But so how do we actually own gold? What are the efficient ways to hold gold? Do I just call up my broker, or how do I do that?
Well, you can buy gold indirectly via a mining company or
Buying a share or a
Exactly.
stock
Yes.
of a mining company. Yeah.
Exactly.
It's not quite the same because you're now taking on the risk of a business, right?
Exactly. So that's one derivative form. Another derivative form would be to own an ETF. That's a paper contract that they'll,
So it's
references
an
the gold
exchange
price.
traded fund, so
Yes.
it trades like a stock, but it owns gold itself. It's a company that owns gold,
Yes.
holds gold.
But both of those are not quite, those are investments, those are trades. If you want to get gold for its role, which is, I like to think of it as insurance, then you want to get physical gold. Physical gold, either in a coin or a bar. And it's important to determine where to store it. If you have a certain amount, then you can feel comfortable storing it in your home. But at some stage, if you have more than you feel comfortable storing at your home, then you don't want to call your broker and have him store it at in the financial system, because that defeats a little bit of the purpose of gold. You're still in the financial system by storing it in a bank. You want to store it somewhere with strong property rights, with a privately vaulted,
Heavily
storage.
secured.
Exactly. And this way, you are leveraging and emphasizing gold's role. You are now taking a physical asset, you are storing value in it, and you are putting it outside of the financial system.
Taking a pure insurance policy on the financial system in a way.
So yes.
So that we're unfortunately running out of time. But Emil, it's been great having you on the show. Your insight into precious metals, particularly around gold and silver, has been of value. And I think the big takeaway is thinking about it as an asset class. It certainly is an important asset class. It is something that's been around for thousands and thousands of years as a form of a investment or perceived value and storage of value. And I think the thing about the insurance side of it is a fascinating way to think about it. So on behalf of the CFA board here, we want to thank our listeners for joining into Money Sense. You can get us every second Thursday. And if you have any questions at all, please email us at moneysense or you can follow us on Twitter at moneysense, and you can email us moneysense@candywacky. Thank you for listening.
Money Sense is brought to you with the support of OneTradeX. OneTradeX, the Cayman Islands